Investors are digesting American retail sales numbers for July. They rose 0.5% from June, suggesting consumers are still spending despite the tariffs. Let's go to Jimmy Lee, CEO of Wealth Consulting Group. He joins us to talk some more about this. Thanks for your time.
Good morning, Morella.
How do you read this? Are consumers sort of buying ahead before price increases kick in, or have they basically sort of shrugged off concerns about the economy?
Well, certainly with the retail sales number coming in pretty strong, it shows that the U.S. consumer is still hanging in there. The recent inflation reports do show that tariffs are having an effect, and I think most investors and analysts have kind of shrugged off the long-term effects that tariffs are going to have. And so I think what investors are focused on really is that the Fed's going to cut. Whether they cut in September or not, I think the direction is going to be down. And so I think people are still questioning whether we're going to get a cut. I think that we will in September. And I think finally, if you start to see the housing market move maybe in the latter part of this year, end of this year, I think that'll be another huge psychological boost to investors. And so I think most people are leaning towards the idea that the analysts and experts that were still predicting a recession to come in the U.S., that risk continues to fade. And so I think investors are being very bullish, and we are too in our investment committee. We like those cyclical sectors. So we favor the market continuing to broadening out actually, and we're bullish equities.
You're talking about Americans looking to a rate cut for September. Are you inside with a bigger rate cut coming?
Well, I think that we do need lower rates. And while I think that we may have a little bit of a temporary effect on inflation because of the tariffs, I think in the long run, inflation is going to be fine in terms of being low enough to where it's not going to hurt the U.S. consumer. And so I think that overall, we're constructive on equities, and it's a really great environment to invest because if you think about it, not only can people think about which kind of stocks they might want to own, but also if you're a fixed income investor, I think you can look forward to lower interest rates, maybe much lower by the end of the year. And bond investors are also excited about what's to come. And so I think it's an interesting landscape for investing where a lot of different asset classes can perform well. And so I think that's one of the reasons why there's a lot of optimism.
Okay, so we're seeing the North American markets hit the record highs again. We're now halfway through the year. You're still seeing the strength. You remain bullish. Do you think we could push past the record highs we've already seen?
I do. In fact, our investment committee, even in April when we were going through the decline, which was, 20% peak to trough. Now the S&P 500 is up over 10% now as of today. It's been an incredible ride, but this is a bull market that is hated. A lot of institutional investors, hedge fund investors have not been participating. And so we actually believe that the call that we made in April, which was potentially a path to 7,000, still exists. Now, I know that sounds like a big number, but I think there's a pathway to it. And again, we haven't even seen the real effects of potential deregulation in the United States. I think you might see some more public offerings. You've seen some of that have come out already this year do well. Private credit in the United States continues to fund a lot of growth. And so I think there's a lot of optimism around higher, index benchmark returns and new highs.
So earnings season winding down now. What are your takeaways from what we've seen so far? I'm going to ask you to sort of separate tech from everyone else.
Yes, and that's, I think, been one of the biggest surprises and what's helped support the high prices and valuations in equities is that earnings have been surprisingly good. And I think what we're going to see going forward is that you're going to see other parts of the market do better. I think, the thesis of broadening out, I believe in it. I think you're going to see small cap stocks catch up to the larger cap stocks in the U.S., the big tech stocks. And for the most part, I think that earnings have been good across the board. And, even if you look internationally outside the U.S., if you're a U.S. investor, I think, those markets will continue to do well. So once again, I know I sound very bullish, and I do believe that we could get a correction. And one of the biggest risks, in my opinion, is that we have a melt up. The market, stretches very high, and then we get a more meaningful correction. But for us, those corrections would be buying opportunities.
What are the sectors you favor right now?
we like the cyclical sectors we have all year long. So we like industrials, we like financials, we like tech on pullbacks. And I actually believe that even consumer discretionary stocks may be good investments. As you've seen now, retail sales have picked up a bit, and I think even consumer discretionary can pick up.
Okay, are there sectors you are not putting money in right now?
You know, I would say that if you've not been in this large cap tech trade, I don't think that chasing now is the smartest thing to do. You know, you saw that, when we do get pullbacks, the names that have gone up the most are the ones that have the most downside risk. So I think, you can use 2022 as an example of the kind of stocks or sectors or asset classes that could take the biggest hit once we do get a downturn.
Okay, you also mentioned that you would invest in tech, sort of if there was a pullback. What kind of pullback would investors sort of look for to dip in?
I think anything north of 3, 4, 5% are investable pullbacks. But I'm saying that if we can get closer to 7,000 on S&P 500 at some point next year or this year, if we get a meaningful pullback of 10% or more, I think those are still continuing to look like great buying opportunities. We think that the lower interest rate environment and deregulation, and as the tariff deals get announced, and of course we're waiting on U.S. and China and U.S. and Canada, those are the two big ones that need to be announced, then we will look for even more optimism for equity investors.
All right, Jimmy Lee, CEO of Wealth Consulting Group. Jimmy, thanks for joining us. Appreciate that.